Welcome to Talking Success, the podcast series that focuses on everything fintech. I'm your host, Darren Franks, and each week I'll be joined by a series of experts in the field who have a wealth of knowledge to share. It's time to meet this week's guest, so grab a coffee and let's start talking success. Hey everyone, welcome back to another episode of Talking Success. If you're listening, if you're watching on YouTube, you may notice something a little bit different. We're in the process of actually building a studio, and this is kind of version 1 or release 1. We've got lots of other plans as well. So rather than just a sort of a boring background, if you sort of keep an eye on the channel, you'll see some interesting stuff coming up. But anyway, let's get into today's episode. This is going to be a really insightful one. I'm following off the previous episode as well with Bazad, and we're talking about sort of deals, and we're talking about mergers and acquisitions and valuations and what the market's doing in terms of fintech. And I'm delighted to have Ashlin with me. So Ashlin Perumall is a partner at Baker McKenzie. For those of you who don't know who Baker McKenzie is, they're one of the biggest law firms on the planet, one of the top 5 law firms globally. They do huge amounts of work in very, very significant deals. Just to precurse this, we won't be mentioning any specific companies and specific deals. Baker McKenzie, as a firm, they obviously respect privacy of their clients and confidentiality. So we're going to be talking around some of those deals, but we won't be mentioning any specific names. So Ashlin, great to have you here. Thanks for joining. I've done kind of the bit of the intro, but I guess there's a hell of a lot more that you can talk about. So do you want to give us a kind of snapshot, what you do in the firm, and kind of your relationship with the wonderful, exciting world of fintech?
Thanks so much, Darren, and actually really great to be here, and thanks very much for including me in the podcast today. I'm an M&A lawyer by heart, and I think a lot of those listening who have been involved in the M&A space know that it's quite a broad industry, and typically individuals who are participating in M&A, they have a broad set of expertise. I specifically am a dual practice M&A lawyer, so I both function as a regulatory and IP tech lawyer in the TMT space, and that's looking at tech regulation, financial regulation for technology clients, and looking and helping clients when it comes to product rollouts, product launches in the financial regulatory space or the technology space, and spending time in sort of helping them unpack the risk and risk mapping. But then that evolves into actual acquisition advice. So I also play a role in acquiring technology, acquiring companies with a lot of assets in IP and software assets, and that's evolved over time as the fintech industry emerged in Africa into specific deal advice for fintech acquisitions. And in terms of fintech acquisitions in M&A, it's been quite exciting and quite broad in South Africa and Africa. That would include your venture capital deals, where we've been seeing a lot of investments, and now more lately your private equity and your M&A deals and consolidation that we're starting to see. So assist across the board. One area that I do enjoy a lot of is actually engaging in policy as well in respect to fintech. So pre-regulatory work and working with clients to identify what government's going to do in a specific area. And I've been fortunate enough to spend some time in San Francisco, actually, at the World Economic Forum conducting research on digital currencies. And that's sort of a lot of the work that I do in South Africa.
Fantastic. Well, that gives us loads to talk about. Before we get into kind of the nitty gritty, in terms of the M&A side of what you do at Baker McKenzie, do you work both on buyer and seller side, or you focus more on the sort of the buyer? Does it depend deal by deal? How does that work?
Deal by deal, but I would say definitely the majority sitting in the buyer side. A lot of the reason for that is that because we are a multinational firm, we have a lot of clients who are operating across regions, both in the Americas, in the APAC region, and Europe. And those are the clients who are typically the ones who would engage us looking for assets in Africa. And in the fintech side, it's either clients looking to take a piece of an investment in a specific fintech target, or alternatively do an acquisition. So definitely a lot more on the buyer side, but that doesn't mean we haven't acted for sellers in the space, particularly the larger sellers moving beyond Series C, Series D into broad M&A.
Yeah. Okay, good. I was going to ask you about sort of what stage, but we'll come on to that a little bit later. In terms of the geographical spread, obviously Baker McKenzie being a global firm, in terms of your area of expertise and your practice, are you Pan-African or Sub-Saharan Africa, Southern Africa, SADC, any other abbreviation we can come up with. But yeah, what areas do you cover geographically?
So we actually have three offices in Africa, in Morocco, Egypt, or Cairo specifically, and South Africa. Our South
Mm.
African office is primarily focused in sub-Saharan Africa, and that's where I play the most important role on the fintech side. But I would say that in Africa you can't really at this scale, and if you're looking for scale deals, look and pick specific jurisdictions in Africa. You do have to have a spread, and the reason for that is that for international investors it's only really the scaled regional players who are large enough for that scale of acquisition. So it's rare that you'd see this be a solely a South African deal, for example. Typically, there would be subsidiaries in Kenya, Nigeria, for example, and other regions just to create the scale that's needed for those kind of size deals, at size that you'd see in Singapore or the like. So I think for us, that means that not only do you have to work with relevant counsel in those jurisdictions, but you yourself have to understand some of the minimum basics in terms of regulation, or at least in terms of how to do deals in these areas. And then that's something that we've gained a lot of experience in just operating in these kind of transactions in Africa.
Okay. All right. Perfect. And then I suppose when you're talking at these big ticket deals, and you're looking at sort of acquisitions, as you've mentioned, that typically are going to be Pan-African or at least have different jurisdictions. There's obviously the regulatory side and the licensing side. How involved do you get as a firm? Obviously, I know you're just talking about some of the work that you do on the regulatory side, but in terms of packaging a deal and making sure that the right licenses are in place, the right sort of compliance processes are there, and the sort of due diligence around that. Is that something you actively get involved in with your clients, or is that sort of down to them?
We actually do get involved in that. I mean, particularly Alpha, because we do, and I particularly do a lot of buy side deals. You get this sense of what exits look like, what buyers look like, and if it's multinational deals coming out of the US as well, you get a sense of what kind of regulatory issues are important to them, and that helps a lot when you're acting on sell side to be able to help clients firstly identify where to prioritize, because let's be honest, startups or smaller entities now looking for exits, they've never had the relevant amount of capital outlay for legal compliance. So they
Mm.
really need to prioritize what's going to be important at exit and invest there early, as opposed to the nice to haves. And so some of the work that we've done with some of the clients who have been looking for those kind of exits is just looking at their relevant compliance and saying, well, these issues, to take a random example in the paytech space, not being completely understanding of all the jurisdictions that you're working in and what regulatory licenses you need, and as well has been able to speak to the upkeep of those licenses, because with fintechs we often see them go out, get the license, and be quite comfortable that they're done, and not look at what are the upkeep requirements in country. What kind of year by year regulatory requirements are you looking at? And for international players, for them to be able to see that there's that robust founder driven legal compliance focus is quite important. And for us, it's we would do, for example, vendor due diligences. We would do a pre-DD and try and help a client package their data room, for example, so that it matches what is expected by international players. So certainly do get involved in that.
And then, Ashlyn, I appreciate the size of deals that you're working on, and the sort of stage that those businesses are at. Typically, are going to be sort of Series B, C, D, and the rest of the alphabet. If we were to give some advice, or if you were to give some advice, and I appreciate this is not legal advice, and no one's paying for your time, but generally speaking, to fintechs who are on the path, they're on the journey, they're kind of seed, maybe moving into Series A, in terms of getting their house in order. What should they really be focusing on from a compliance perspective, from a data room perspective? What are the key aspects that would help them now, rather than when they do come for an exit, or they come to an event and they go, it's going to take us 6-9 months to get all this documentation in place. So is there any sort of best practice or any sort of general advice you can give?
Yeah, I mean, specifically Series C, Series D, and even Series B. That's where we've seen a tremendous amount of investment over the last years. It's tapered off a bit in 2023, but after the pandemic, the valuations were eye-watering.
Yeah.
And what that meant is that you've got a company who's just they've had their seed round, they've kind of grown a bit, they've got proof of concept, and now they've gotten clients. And typically, when you get to Series C, you've kind of solidified some part of your market, and you're looking for money to broaden out and go to another country, maybe incorporate and relaunch in Nigeria outside of South Africa as an example. That's typically what targets are looking at to utilize the funding for.
Mm.
And when they do that, you would go to, for example, a US investor. Structure a Delaware company as your top co for the relevant investment, and then you would bolt on your South African or African group structure underneath that entity, and that's what we've seen time and time again. The problem is that you're moving from a very small startup to valuations of, for example, 20 million US plus, and sometimes the rounds are significantly higher than that. And the problem is that with that level of money being outlaid to an entity, the expectation of compliance and having your house in order similarly increases. And that's sometimes a bit jarring for particularly South African companies where our venture capital markets valuations are much, much smaller. You
Mm.
suddenly throw into a mix where you've never had this amount of capital to attribute towards legal or regulatory compliance. And now suddenly you're taking an investment where you're going to be expected to be compliant. Now, the areas where we see a lot of issues, and these are issues that can be cured early on, is firstly license and regulatory mapping. Now, I don't mean just getting the license. I mean mapping what licenses are available for industries in your market, and really being able to talk to investors about where are their gray areas, where are their hard regulations, where are the regulations that are hard that don't apply to you, and be able to have an answer for all of those. I've time and time seen again that a target will say, well, we've got the licenses, but they don't really understand their environment and what licenses they should have, or have an answer to licenses that they don't think are applicable, and really being able to speak to that. So I think regulatory mapping is as important as getting licenses that you think are important, because investors want to see that kind of rigor in your understanding of your environment. The second is structuring. A lot of founder-driven entities are structured in different ways, and there'll be founder shares or incentive shares for employees or developers or the like at the early stage. But those aren't structured the way cap tables work in the US, for example, for a US transaction. And sometimes the homework and the clarity isn't done well. Their share certificates haven't been issued, or you've promised shares but you haven't completed the paperwork. These are easy things to solve, and it's
Yeah.
just admin. And sometimes I know it's sometimes really expensive to do this through a law firm when you're in your seed phase, but just having someone in your team who's dedicated towards making sure that your documents are well kept, they're easy to identify, and when it comes to your structuring and ownerships, that those are very belted down and clear. I think that's another area that's quite important. The last that I think, I mean, there's many more, but
Sure.
I'll leave
Yeah.
you with
Yeah.
a third one.
Yeah.
The third one that I think I've encountered quite a lot is, in founder-driven companies, there's a very small deal team, and that means that the institutional knowledge is usually not institutionalized. The institutional knowledge is sitting in the heads of individuals. Usually a founder, maybe a co-founder, and a team of 5 people, and they may have employees underneath them, but the real know-how sits in those individuals.
Mm.
Now, in those kind of instances, the valuation question changes, because now, an investor has to look, is this an acquire hire? Am I hiring a team, or am I buying an institution or investing in an institution? And so some level of, externalizing the know-how is quite important to show tangible value. And that's something that I think that's quite important. And where it impacts a lot is when you have these discussions on investment valuations, you have the discussions on warranties. You might have to have tie-ins or lockups for these individuals, just for investors to see that the valuation is secure once they've acquired it. So those are the kind of things I would sort of front end in any startups approach to investors.
Actually, I'd like to just come back on one point that you mentioned at the beginning of that, which is in terms of structure. I'm not talking about sort of cap tables and shareholder structure, but in terms of how the business is structured. In terms of having a Delaware or a Mauritian or an Irish or a UK or a Dutch or headquarter. Times have changed, a lot in the world of compliance and AML and everything like that. There is a requirement now to have substance in a country where you are headquartered. So again, when you're looking at advising your clients on making an acquisition, is it important, or how important is it, that there is substance in the holding co, which may be offshore? Is that something people really need to be focused on? It's not just a case of getting a PO box in Delaware or an accounting firm in the UK and say that's head office. So is that something that's quite heavily scrutinized these days?
Absolutely. And it's changed so rapidly, Darren. I mean, I remember 10 years ago where you would have all sorts of, a zoo of tax structures, for example, out there with various entities interposed to create, presence. And that's, with the new changes in terms of global approach towards PE, towards transfer pricing and the like. There really isn't an argument that can be made that you can operate in these jurisdictions without some level of substance, especially if you want to go to serious investment stage or scale stage, and that's becoming quite prevalent and quite important. The other aspect outside of tax is for South Africa is exchange control, and why I raise that is often with fintech acquisitions there's a lot of IP. It might be in the software, it might be in certain relevant trademarks, or there is typically a large portion of the deal that's IP focused. Now, for South African entities who essentially develop all of their IP in South Africa, you're going to suffer the lock-in problem of having to try and explain to an offshore investor, how are we going to externalize this as this business grows outside of South Africa? And, in the past, US investors, as an example, wouldn't have understood that. Lately, because of the amount of African investments, they know what intellectual property, they know what exchange control prohibitions on export of intellectual property are. They're very capable of assessing these as risks. So what that means is that if you actually want to say, no, the IP is not sitting in South Africa, we've got an entity in Delaware or Cayman Islands or wherever the case may be that's licensing the IP or developing the IP, they're going to want to see substance to that. Do you actually have bodies on the ground, software engineers in those jurisdictions? Is this genuinely developed in those countries, or was this just a means to get around the nuances of South African exchange control? So investors have had a good opportunity in the pandemic and post-pandemic to do a lot of investments and gain the know-how, especially the funds. And I think they're much more savvy now as to what to look out for, and where there's structures that don't seem to have some kind of proper defensible reason to them, they're going to scrutinize that and either tell you, listen, happy to invest, but you need to do some pre-deal restructuring, or we're going to invest, but we're only going to carve out this, and this, and this, and then the founders are left with a lot of assets that they don't have a business to run with. So I think that this is going to be a recurring theme, but thinking with the end in mind is incredibly important, and being, I think, fairly authentic towards how you structure is also quite important. Caveat to that, as if I may, is just that 2020 saw a lot of the investments come out of the US because of their venture capital market size. It's so much bigger than ours. But entities investing there aren't really looking to invest in South African companies. They want to invest in a US entity. So the reality is that's one piece of structuring that I've seen to be quite common. And either having an entity in to take random examples, Delaware or Alabama or Austin in Texas, it's becoming important for them to have entities that they understand on the investment side, and then you run your due diligence and your checks on the actual group on the operation side and split those two things out.
But how viable is that for a relatively early stage startup who, let's take South Africa as an example, who has got some traction in the market, perhaps is now moving to seed or maybe Series A, and is saying, well, actually, if I then go and put a headquarters in Delaware or the Cayman Islands or any other jurisdiction, and I have to employ people locally to do that, obviously higher at a premium to what you would pay for the talent here in South Africa, all of a sudden the way that you go to market and your financial models is going to be very, very different. It's going to have a big hit to that. So at what stage can this kind of be unraveled and repackaged and sort of headquartered without obviously, cheating any systems or anything like that? But, if I was a fintech and I've got a bit of traction and I'm thinking, actually, I can take this Pan-African, or I can take this into Asia Pac, or I can take this into Europe, or wherever it may be. I need to get some investment. I would like to get US investment. At that point, is it relatively straightforward to go and set up a sort of another legal entity to transfer that IP, or not?
It's very expensive, and I think that answers a lot of the questions of what stage are you in terms of that long-term journey for investors, and how much capital do you want from them? Because the more capital you want, the more they're going to want to have the investment structured their way. And that's a risk. So if you had seed stage and you just you want to take a US investor as investor as an example, you don't really need to get into the complexities of US venture capital documents like the National Venture Capital Association precedents or safe notes or the like. You can do that with ordinary instruments issued from South Africa for low valuations, and there I would say to be honest, it's just not worth the amount of money it costs to just incur the legal and financial costs to comply with the relevant requirements to do that. There you might want to propose a much lower valuation, and then thereby do it with much simpler investment mechanisms.
Yeah.
The second that this kind of structure becomes relevant is when you are looking at you post your proof of concept, you post the point of acquiring customers. You're now at the point where you've actually proven your market share, and you actually want to now go and gain more market share. That's typically where we see this kind of be the scenario. And normally when you're looking to gain market share outside of your country of origin. Again, Kenyan entity has grown massively, done incredibly well with a particular fintech concept, now wants to expand across Africa. That's the moment when I would say, okay, now you need to think about where you're going to get the capital for doing that. Are you going to source that in country? Or are you going to source it externally? Are you going to now start your investor rounds? And if you're sourcing in the US, that's the moment where having these structures in place will be that much easier to sell to a US investor or to a fund. So I think that's the moment where I would say that's when you're ripe for these kind of considerations.
Yeah, but as you said, it's not straightforward and it's not cheap. So
Nope.
if you're going to do that, be sure that A, you can get investment, and B, you're doing it for the right reasons.
And I mean, as you would know, in investment rounds, you're typically going to have a lead investor. So you would have done some solicitation, some conversations at the beginning, and normally they're the ones who will tell you, listen, we're gonna speak to our network, or we're going to talk to other funds, we're going to bring on other investors into this journey. But they're a great source of guidance as to what you would need at that stage. So I think one key, and this is made or break or broken deals, is having a good lead investor and having a relationship with a good lead investor who believes in your fintech and wants to invest, and is willing to sort of help you in that journey, because that also tells you because your makeup of investors could be very different from transaction to transaction.
Sure.
Sometimes it's the mavericks, and then there's less concern about these sort of things. And other times it's institutional investors or quasi-institutional VC investors. In those instances, you need to think a little bit more like a much more scaled up entity. So using your lead investors' know-how is a great source of sort of prioritizing and cutting through a lot of the unnecessary costs.
And I think as well on that, there is a lot of bad advice out there. I think people have been burnt. I know certainly a handful of people that have had the wrong advice. Perhaps haven't sought counsel, perhaps haven't spoken to their lead investor, or people that are well versed in these types of things. So I think the message is appreciate that funds are tight, and you want to probably pour more money into product development and customer acquisition than you do legal fees, but at the end of the day it might cost you more if you don't get the proper advice. Having been burnt myself once or twice, I now it's not a it's not a payment that I make and go, but you get some good advice, and I would definitely recommend anyone that's going on this journey to seek some legal advice, especially when it comes to things like contracts and it comes to term sheets. Because if you've got a fintech and you've not come through, maybe you don't have a law degree, you've not come through business school, and actually you're an entrepreneur and you founded a great product, great market fit. You can see kind of the unicorn appearing over the horizon, but then you sign a term sheet that you may find a bit later down the line you've lost a lot from. So definitely advice would be seek some professional advice. Ashlin, let's move on a little bit. You touched us a few minutes ago about the market and what's happening here in Africa in terms of the fintech market. Obviously, the last year or two, valuations have taken a bit of a nosedive. What are you seeing now? Appreciate where are we now? We're early September 2023. So what are you seeing at the moment? Any predictions? I appreciate anything we say here is our own personal views, not the views of the businesses that employ us. So it'd be good to get an understanding what you're seeing in the market.
So, I mean, the one thing I am not seeing is investments being made off of PowerPoint decks anymore. what we used to see in 2020. So, I mean, the shorthand of that is that there's a much higher expectation on the entities being a bit more robust and a bit more with the real proof of business, which is a big change. The one thing I'll note is that the payments industry. So, I mean, fintech covers a broad range of different types of fintech players, and I'd say payments is the one that has hit its maturity point. We're starting to see consolidation in payments, not just payments, but cross-Africa remittance, where you're now starting to see these not being venture rounds, but actual M&A deals. So we're seeing a lot more full-on acquisitions, 100% acquisitions. We are starting to see some venture capital spinning off, private equity spinning off their investments towards the larger players. So I think that payments has now hit its inflection point, and of that, there's going to be a lot of big succeeding stories with big players who've been successful, and there's going to be a lot of losers. The smaller payment services are going to maybe be squeezed out of the market as these move into much larger multinationals. So that's one we've seen a lot of. The crypto industry is obviously completely flattened out. We are still seeing some deals, but it's morphed and changed in terms of what's the crypto focus. In terms of your broader digital asset infrastructure investments, those are still happening, but not at scale. But your more exotic investments are just not happening. There is some spin-offs happening in that space where either assets, sub businesses, or successful technology projects within exchanges and the like are being spun off, and that's something that you're seeing on a much smaller scale, but we're not seeing too many of the big deals, or at least the significant deals that we saw in previous years. What's gotten quite interesting to me in the last 2 years is digital banking. Both digital banking on the one end as a fintech vertical, but also open banking. Yep. So on the digital banking space, we've seen and we've been involved in some pretty large digital bank investments. And what I've identified is that the success of some of these companies in being able to broaden their margins for services because they don't have brick and mortar, it's just created a new beast in South Africa across a few of our digital banks, but also I see a couple of other countries starting to look at that as well. We're starting to see digital banking being the one vertical that's not actually as mature yet in terms of fintech players, and I think that's going to scale much differently to where payments is at. In the open banking space, that's really interesting at the moment, especially in South Africa. We don't really have hard open banking regulations yet, but I know that from the recent seminar that the FSCA is actually looking at establishing some sort of open banking regulations to sort of allow for information sharing between non-banks and banks so that customers can get the services that they want. But that's interesting because this is proprietary information to the bank, so I'm not sure how much of coming to the table there's going to be at the initial stages. In the UK, for example, open banking is regulated much differently. There, it's prescriptive that you should share, that there should be a flow of information, and in South Africa, it's much more of voluntary approach that's being promulgated, and I think that's going to start to shift some of the players, and that we're starting to see some investments, some companies looking and preparing themselves for these kinds of activity. The last one that I'd mention is I think a pretty obvious one, and that's telecoms. I think the telecoms industry in South Africa specifically is now not cottoned on, but realized the value of their fintech arms, and there's a lot more ring fencing those businesses and then splitting them out so that they can grow on their own and perhaps be listed. I think that's something that could be quite interesting going into the next couple of years, and there's preparation for that happening in South Africa and other entities. So I think the mobile money space in South Africa isn't as robust and broad as it should be when compared to other countries in Africa. Perhaps because we don't have e-money or m-money like you do. We've got ordinary bank systems, and that's what we have to work with. But I see that transforming quite substantially in the next 4 to 5 years.
Yeah, I mean, listen, about to say something that's obviously public information. MasterCard's investment into MTN FinTech only a couple of weeks ago, $30 million. That's a big chunk of change. I think I don't think, but when we've been speaking to other sort of guests on the podcast, and we were talking about the kind of the race for the super app, a lot of them are kind of hedging on the telcos, the MNOs, really to be that. They've got huge customer bases. They've got the technology, they've got the services, they've got all the integrations, they've got loyalty. They really have everything sort of wrapped up. So I think that's going to be very, very interesting. You mentioned crypto. If you've watched any of my episodes on here, you know that I'm a massive crypto fan. Not as an investment for me personally, because I'm looking at the top of my screen, going, it's all red. But in terms of the utility behind crypto, you mentioned cross-border payments as well, and I think there's a huge opportunity there to use blockchain and crypto to reduce the time and the cost and the complexity around how you move money cross-border. Obviously, we've got exchange controls in South Africa and other African countries, which are going to need to be navigated, and that's clearly probably on your radar as well when it comes to CBDCs. But you mentioned there are some deals still happening within the sort of crypto world. Again, from a valuation perspective, have they taken a nosedive after what's gone on with the likes of FTX and the other ones over the last year or so? Is there a little bit more scrutiny on the sort of structures that sit underneath that, the treasury side? Is what's sort of happening in that world?
So in that world, I think a lot of the focus is trying to understand where African countries are going with crypto regulation. I think if you take a sampling of about 5 or 6 African countries, the approach is as diverse as they come, because some are wait and see, some have hard regulations, some are friendly, and the problem is that once again, if you're really buying entities at scale, you need a couple of jurisdictions in a basket to make it work, especially in the crypto industry where you're talking about smaller portions of market in each country. So I think that's where it's become quite tricky for crypto players. The reality is that it's really hard to structure an environment where there's that much legal uncertainty as to what your product's going to be regulated at. Now, crypto is again, like fintech, one of those terms that covers so much in terms of actual business operations. What I sort of am quite keen and interested on at the moment is firstly crypto for payment rails. So basically cross-border remittance, we're using crypto as rails payment. There's a number of companies that are doing that in Africa, and doing that across regions in a legal fashion is something that's a lot of companies are looking to find ways to do that. And the other is, what the crypto world has evolved into in terms of the DeFi, liquid staking, and the ability to do liquid staking, and whether or not African countries are going to regulate that as hard as some other countries have, which are like Singapore, where they've clamped down on liquids, on any form of staking. Now, Ethereum or Ether, they've leaned into staking as a means to allow people to gain value, and you lock in your assets into specific smart contracts, and you get the ability to earn 4 or 5% interest per annum. But it's a great way of still gaining and beating the independent token valuations. And There are players who provide services around that. So there could be, firstly, brokers who can help the average consumer. There's companies that we've seen come into South Africa and get broker licenses in order to do that and acquire financial service provider entities in order to provide those services. We've seen a ton of that in the last year or so. And there it's just really saying, well, listen, how do we deal with what's currently being taken up by the market? And where is the gap for the average user to be able to access those opportunities? Well, I've seen there's a lot of startups that are focusing on that middle ground space and saying, well, we'll create great UI, great interfaces. We'll go get the FSCA licenses and the phase licenses in order to be able to provide brokerage financial advice, and then we'll interface. So let's play in the middle. That's again tapered off a lot in Q2, Q3 this year. And I'm very interested to see which direction the crypto industry goes from here. A lot of this is influenced by the approach in the US. And where I'm concerned about the crypto industry right now is after South Africa's graylisting. You would have seen the likes of Kraken and Circle blocking deposits coming out of South Africa because we're seen as a graylisted country. These are crypto exchanges in the US blocking South African fiat deposits. It tells you how much of an impact our graylisting is going to have on the US's and other countries' perception of us as a safe place to be crypto dealing. And I think that's going to impact a lot of the deals that we're on at the moment.
So you mentioned the grey listing. How has that affected acquisitions, deal flow here in South Africa from overseas investors? Has it spooked people or investors? Has it had an effect on valuations? Has it had an effect on volume? What's actually happened?
I think it's had it's had a lesser effect than I would have expected. And I think partly because a lot of the fintech deals aren't institutional investments. These are actual buyers or fund investors who are used to risk, and they're used to emerging market risk, where there could be something like a grey listing issue. The problem, though, is that the second you get anti-money laundering compliance as part of the key compliance areas for a fintech, so for example, the digital bank, that's where the concerns start rising, because the policies, and it might not even mean laws, it might be the policies of an acquirer overseas for dealing with anti-money laundering and counter-terrorist financing. Those policies in and of themselves prevent them from making these investments. So you don't see the investment, so it doesn't impact the investment. It just doesn't appear on your radar because companies that would have invested haven't. And that, for me, is maybe one of the reasons why we're seeing some less investments in Africa. But I would say this: I am not seeing investments that are not happening just because of the grey listing. I think it's one of the factors amongst other factors for South Africa as a investable emerging market that is considered, but it's not. It's never, in my experience, it's never been the sole reason.
Actually, you mentioned, I appreciate this is just an example, a lot of sort of deal flow and investment coming from the US. When we look at BRICS and what's happening in BRICS and the other countries that are coming into to that union, how do you think that's going to affect investment into South Africa and the rest of Africa? Do you see that being a positive? Let me ask another question. You can answer them both at the same time. When it comes to looking at investment from the East, are you seeing more deal flow there from, whether it be sort of the Middle East and onwards? Obviously, there's been a couple of Middle Eastern deals that have happened over the last couple of years. But then we look at, Hong Kong, Singapore, India, China, Japan, etc. Are you starting to see some level of interest, or what's that happening in the other parts of the world?
I have to be honest, I don't see as much as, it's a fraction of what you would see out of our typical investment partners such as UK, US, Europe, and also other African countries. But you do, so we've done a few deals coming out of China, Hong Kong. There is some interest coming out of Africa. Enterprise Singapore in Singapore is a good example of, they've got a specific Africa focus group that's tries and connects the investors and the startups that side with the investors and startups this side. So we've seen activity come out of that. So where governments see Africa as a destination for investment. But the scales just, they're not there yet. I mean, Russia, for example, as a total trading partner is about 1-2% of our trade compared to the US, which is significantly, it's tens of percentages. I think it's like 40%. So the reality is that you talked about economies of scale here in terms of that investment. It can only, to answer your first question, it can only be positive and more positive for us to be more internationally connected. And not just internationally connected in terms of investment with the West, but also with Eastern countries where fintech is actually solving very similar issues.
Absolutely.
For example, in Malaysia and Southeast Asia, issues that are easily replicated in Africa. The thing though is that a lot of the jurisdictions they're usually destinations for investment for the money markets. Or they're interested in money market scale deals where the size of deals we have in Africa they're just not big enough. I think they're big enough for broader US investments who are, familiar with the territory or European investments, for example, out of Amsterdam that are familiar with South Africa and Africa, but less so for Asia. I think that if we can allow for those corridors to open up, it can only be a good thing. And from a deal flow perspective, I think that'd be positive. One of the major barriers that I'll leave you with on that question is that our regulatory environment is very different, extremely different compared to those regions. So for them, we are a very exotic territory for investment, and I think that's one thing where we're not really harmonized with the approach towards a lot of this in the East.
Okay, all right. Let's talk about the dollar versus the rand. So we've seen. I mean, this morning it was I think 19.3. To the dollar. It's kind of been between sort of 18.5 and 19.5 over the last couple of months. Are you seeing international investors sort of seeing this as an opportunity now to acquire some businesses in South Africa? And obviously, there's the other currencies across the continent have also been severely devalued, even more so than the rand. Are people seeing that as an opportunity, or is it scaring them off a little bit, thinking it might sort of swing the other way? What's the view?
I mean, I'll speak here both fintech, but also broad and M&A. But
Sure.
That's been a boon to the trade buyers because a lot of them are going to make these acquisitions whether we're in a downturn or not because they have market share here or they want to gain market share here. It's within their industry, and they're not buying for growth or investment or spin off like a PE. They're buying because this is a bolt on for them. So for them, the discount value that you get from our currency, but not just from our currency, also on the valuations being what they are. It's fantastic. So we're seeing a lot of that, not just in crypto, but a lot of these trade buyer deals starting. The ones that have been shelved for 5 years and are like, okay, now it's right now to pounce on these. But the circumstances are very, very case by case. I've noticed. So I think that the dollar has only helped where companies were already looking at South Africa for a time and are now seeing this as the opportunity. I have to be honest, I haven't seen any new deals where there's been a focus on making an acquisition in South Africa just because our rand to dollar rate is bad. It's typically someone's been doing their homework for some time and is taking the opportunistic moment to pounce. Where it's perhaps I would almost say surprising is that we would have expected to see a lot more of your seed and startup investors, perhaps going and looking for lower dollar valuations, because the deployment of that capital is just, you can do so much more with it in South Africa than the same investment being made in a San Francisco startup, for example. There's just so much more you can do with that money, and especially now when the rate is low. Now I get that obviously VC globally has dried up, but I would have wanted to see a lot more startups, using the opportunity in the reverse, going and telling investors, listen, you invest in us. We've got these projects, we've got these things we can do, and we just need a fraction of what you would invest in this overseas startup, and when we can deliver some sort of growth, and that's an opportunity that I think is perhaps being left on the table.
I think talking to a few people last week as well, and I think there's a bit of a surprise that even the early stage funding, whether it either comes to friends and families or pre-seed, that's kind of dried up as well. And that's not even touching the VC market. And unfortunately, that has a negative impact over the next couple of years in terms of, incubating these businesses and getting new ideas out there, new products. I kind of asked you before, but we kind of went around it a little bit. Your view, your prediction for what you think is going to happen over the next 12, 24 months. Before you answer that, this is not legal advice. We don't have crystal balls. This is purely two people chatting about the market. Ashlin, what do you think is going to happen?
Nor is this financial advice.
Nor is this
but
financial advice. Yeah,
I'm,
absolutely. Yeah,
I'm,
that's
I'm
right.
always a fan of crystal ball gazing if I'm not held to the results. But no,
Mm-hmm.
the honest truth is, I think in some countries, but not all, we're starting to see the inflation tactics of the Central Reserve Bank starting to have their effect. South Africa, I think by 2024 is going to have seen, hopefully, a peak of inflation. And even in some other countries now, excluding Australia, for example, but if you look towards Europe, there are some countries where there's surprising success of the inflationary prevention tactics that have had an effect. Now the reality is that's so important at a macro scale because that tells you how much speculative capital there is in the market. Because the less people are worried about having to pay more for debt, the more they're willing to invest speculative capital in the kinds of investments they did in the 2020s. And a good example is emerging market investments, emerging market fintech investments, I've maintained this, right up until 2022 and maybe even 2023 were incredibly resilient if you looked at what was happening around the rest of the world, where investments just shut off and taps dried up, Africa was still seeing. So we lagged in terms of the drying up of those investments. And my argument is because there are real use cases in Africa. There's real markets. Nigeria, for example, has a massive market, and if you can solve problems there, your ability to transform those business models and scale them quickly, it exists. So you got real use cases, you got real problems that need solving, and that doesn't go away when there's a drive of investment money. So I think that once we start seeing that peak and people start saying, well, listen, we're heading the other direction now, which may happen in the next 2 to 3 years, maybe even sooner. I think that Africa may become a huge focus territory for deploying the re-emerging speculative capital. And where I'm excited is that the companies that build now are the ones who are going to be at the ripe stage when that happens. I've always said this, some of the biggest companies, some of the biggest listed companies in South Africa were built during the Great Depression. They were built at times when things were really, really hard and you would not have started a business. You would have been called crazy to go and start working on a project, but they built in that period. And then when the money became available, they were ready. As opposed to companies that wait until inflation is over and only then start testing their proofs and going out and soliciting investors and getting people aware of their existence. So I think give the world 2 to 3 years and barring another war starting somewhere around the globe, hopefully things will balance out.
Yeah. Do you think valuations will get back to the same levels they were in sort of 2021, 2022?
Oh, that's a tough one, Darren. I listen, when that happened during the pandemic and after the pandemic, I couldn't believe what was going on because especially in the crypto and the technology industry generally, and then the different hype cycles that happened with we had DeFi, then we had the boom with crypto again, and then we had the metaverse and different kind of cycles that led along that. I I
Don't
think
forget the NFCs as well, right?
Yeah, NFTs is part of
Yeah.
the amount of investments that happened during that phase in businesses that um, had no customers, had no built product even. They had a slide deck and an idea, and they would go and do a Y Combinator or something and get investment. And they were getting incredible investments out of Tel Aviv, out of places like San Francisco, out of places like Singapore, and I I feel that silly season was very, it was a unique combination of there being so much more capital available because of the pandemic, but also a lot more focus on technology because everyone was glued to their. I mean, these are just my anecdotes, but people being glued to their devices that that just gathered that amount of attention. I don't know if we're going to ever see that. We might see the same numbers again, but not at that volume again, in my opinion. But maybe I'll be wrong. I'd love to be wrong in terms of that assessment.
I think you mentioned open banking as well, and I'm keen to get your view on this. Um, Again, I'm not going to mention any names here, but there are fintechs who effectively are sort of plugging into a banking ecosystem and providing effectively a UI and a UX for consumers. So they're responsible for going to get the consumer, for packaging the product, but actually the core technology is being run by the bank or the financial services institution. When a company is looking to make an acquisition of such company, is there value attributed to that organization because it's actually not their tech that's running the fintech? It's kind of a bit of a sort of a window over the front. So what's important if someone's building a fintech? We've got people obviously listening here that are doing exactly that. What do they need to focus on in terms of IP, and what would investors look at?
So two things. I mean, well, three things actually. I would say the first is the customer base. If you've got that customer book, and you've got recurring and returning customers, that's incredibly valuable because that's hard to get at scale. And particularly if you've got those customers and you already know that they're banking customers, you've got a sound sort of customer base. So that's one. Your goodwill with your customers is definitely one. The second I would say is I wouldn't discount the amount of complexity in the tech for your open banking players. Running screen scraping or API listening protocols and developing the relevant systems around that sounds easy as an idea, but it's in an implementation, it's hard. In implementation that is secure, that meets the relevant cybersecurity requirements, that is data compliant, that is not infringing some sort of right on the bank side where the bank could come and close you down. That's easier said than done. And companies that have done that have a good 2 to 3 year lead time on someone who just says today, I'm going to go and create an open banking startup. So it's much easier to acquire those than create them on your own. So I would say I wouldn't discount the amount of work that goes into creating APIs such as this or mechanisms such as this to integrate with the banks. The last is data. I think the data is incredibly important. And, whilst we would have thought that, and in South Africa, we would have thought that after Papaya, there'd be a much more focus on data. What we're realizing, and I've definitely realized, is we're not Germany in terms of our consumers and our South African data subjects and their desire for protection on privacy. Privacy is important, but in South Africa and in Africa generally, people are much more willing to give up some level of privacy or give up their data for the benefit of free or some sort of low-cost service.
Yeah.
For us, the access to service is what I'm noticing much more important than the privacy. And with that being said, ownership of that data is more important than sort of keeping that data to yourself. So I think consumers are wanting their data to work for them. And if an open banking API or provider is providing a much better user interface or integration with their financial services, that's what they want. And I would think that if you were an investor, you'd have to look at least those ingredients there. They know and they're able to have the relevant, robust requirements and data, and they've got sound consents from those consumers saying to them basically their terms and conditions. We want to use you as our provider for our data, and you're welcome to gather that from the bank. But secondly, that book of business, and then lastly, creating these mechanisms sound easy, but there's a lot of IP in the software that goes into this, and unless you're coming at this with a robust developer team, buying is sometimes much better than building.
Okay, and there's plenty of options now, absolutely out there. There's some amazing platforms that you can just sort of plug into, go into a sandbox environment, test, make sure you've got the compliance, and then sort of go to market. You mentioned about the sort of data protection, and it just made me laugh because I was reading last week the chaps from ChatGPT or OpenAI, I think it is, setting up the sort of cameras, and they'll take your sort of biometrics in exchange for like a token or something like that. I'm not sure. But the other aspect of data is data sovereignty, which is a big issue now across the continent. That makes life a lot more complex for a fintech. And I would imagine if you're advising, sorry, I'm putting words into your mouth. Let me rephrase that. If you were advising a customer or a client of yours on acquiring a business that is multi-jurisdictional across Africa or anywhere for that matter, when you look at data sovereignty, is that very, very complex? Is there a requirement now to have physical servers in data centers in the country to be able to prove that you are retaining your consumer data for those nationals in that country? Is it very complex? Has that sort of had a big impact in the negotiations when you're talking to these potential acquirers?
Not so much the negotiations, more the risk identification. So there's two aspects to this. The first is the EU's GDPR has, through their adequacy requirements, caused inadvertently a lot of harmonization around the world. So countries wanting to deal with the EU have sort of harmonized their laws so that there's some level of ability to integrate. So that makes it easy if you can identify countries that have done that, and if that forms part of your pool, that makes it much easier. Second is data localization. South Africa, for example, doesn't require data localization in Papaya, but there are countries in Africa that do. And we would want to identify which countries are those and what data needs to be localized. Because the second that happens, and that's included in the deal, it sort of limits your cloud ability to operate and your scalability by cloud.
Yeah,
Because if you just think of this practically, if you want to scale and you have to have all your data localized, for example, in Kenya, is there a local cloud provider who can actually scale that fast, like an AWS can? And if that's not, that's creating a ceiling towards your scalability, at least from an infrastructure or capital outlay perspective.
sure.
So it definitely forms part of the discussion on diligence side and perhaps valuation side, because it may mean that there's a certain size that certain businesses can grow as a result of that localization. Now, there's companies out there have come up with very clever solutions around this, and also to put in place the ability to transfer data within the regime and not having it all completely localized, or at least mirrored, so that they can scale offshore. But that's a particularly complex question when it comes to the diligence side, because, as I said, it can create business product limitations.
So I was talking to Kun Yonker from Time Bank. He was on a podcast a few weeks ago, and we were talking about sort of different markets and why Time Bank haven't looked at sort of the rest of Africa. And fundamentally, in order to operate Time Bank is operated in the cloud, and if the regulations don't allow for that to happen in a specific country, then it's a very, very difficult route to market, route to entries. Hence why they're looking at sort of what open up in the Philippines and some other areas. So yeah, I think for anyone listening who again is building a fintech and wants to take it, pan African, these are these things you need to think about. How are you going to solve that problem of sovereignty if you're building something in the cloud on AWS or Azure or Google Cloud or wherever it may be? How are you then going to operate in another country that perhaps doesn't have yet that sort of infrastructure in place? So I think there's some certainly some things to talk about. Ashlin, before I let you go, I wouldn't be doing my job properly, and I wouldn't be sort of doing you justice if I didn't give you an opportunity to just talk a little bit about the firm itself. What other areas? Obviously, you focus on M&A. What other areas of law and corporate law can Baker McKenzie offer to fintechs? And I appreciate, it's a very big firm. If you're, just starting up in your garage and you've got some, friends and family around, perhaps not quite yet for Baker McKenzie, but something to aspire to. So if you can give us a bit of an overview in terms of the firm, what the firm offers, that'd be great.
Absolutely happy to do that. And I mean, just a little bit about the firm. We're an international firm, so we've got offices across the globe, and we've got about 60 years of experience in working in the financial industry and with industry regulators across the world. And what that means is, and what it's helped with, is being able to just draw on that experience for different areas of service lines that you get in fintech. And what we've been doing for a number of clients is other than mergers and acquisitions and financial regulation, there's also systems controls and procedures type work, and that's looking at your AML policies and compliance, customer due diligences and the like. That's much more scaled down and affordable for the right type of startup. And we have a very robust cybersecurity team globally, focusing on advisory, regulatory disputes, investigations and incidents issues. A very robust data and technology team, both in South Africa but globally, where we'd look at your data privacy, technology and IP transfers. I particularly do a lot of work in AI regulation, AI policies, and some work in respect of blockchain infrastructure projects. So we're able to draw on a wide network of expertise, and also contracts and alliances and partnerships. So outside of your big M&A deals, looking at partnering with the right type of joint ventures or expansion business opportunities, those kind of contracts typically require good, sound experience, and that's something where we're able to draw on a wide network of experience for that, and something that we assist a lot of clients with. So I'd say that not everything is a large M&A deal or a large matter. There are a lot of in between small steps that are important to get right, and we assist on a lot of those, especially in the fintech industry. And if there's any questions of anybody or one of your listeners wants to reach out to us, I'm sure our details will be available along with the podcast as well.
They absolutely will. If you're watching on YouTube, they're going to be down here. If you're listening on Spotify or Apple or anywhere else, they'll be in the description. But actually, if people want to reach out to you, if they've got some sort of questions or want to engage with the firm further, best route to contact you via LinkedIn, or how do you prefer to be contacted?
I'm usually open to any source of contact. My email address is typically available on the website, and I'm sure will be linked. But feel free to add me on LinkedIn. I post a lot about these topics on LinkedIn. So if there's any fintech or other technology issues that interest you, I'm always open for a conversation. And I'm keen to hear if there are any thoughts or comments in respect of what we've discussed today as well.
Wonderful. Well, thank you for your time. Thank you for your team as well for facilitating this. Appreciate you're a busy man. I'm going to go and get ready because I'm off to Visa this evening because the Swiss Embassy are hosting a little event which we've been invited to, which is talking about investment into South Africa from Switzerland. So that'll be nice. Hopefully they bring some nice chocolates with them. But Ashlin, thank you so very, very much. Actually, maybe a Rolex would be nicer than a box of chocolates. But anyway, have a wonderful day. Thank you so much for your time. Really enjoyed it, and we'll speak again soon.
Thanks very much, Darren.
And that's a wrap for this week's episode of Talking Success. Thank you so much for tuning in and joining us for this fascinating discussion on all things fintech. We hope you've enjoyed this episode and have gained some valuable insights into the ever-evolving world of finance and technology. A huge thank you to our guests for sharing their expertise and providing us with some amazing insights. We certainly couldn't have done this without them. Don't forget to subscribe to our podcast and stay tuned for more exciting conversations with experts in the field. Until next time, keep learning, keep growing, keep talking success.